Hello and welcome to this State of the Economy special, where we will be discussing the main numbers on the CPI numbers, the October CPI numbers that are due anytime now. We are still waiting for those numbers. The CNBC-TV18 poll indicated that the total headline CPI could be 4.8%, which is a significant reduction over the 5% in September, but more importantly, the 6.6% that we had in August. So continuous fall in CPI numbers is what we are expecting. Now, we have with us a gallery of economists to speak with us. Okay, I think the number is with us. If we can get the flashes, I think it's coming in at 4.87. So that's slightly higher than what the street was expecting. CPI inflation at 4.87 versus 5.02. So that's a slightly higher number. We should be getting more details in a bit. Just waiting for the things to flash. We'll be with you in just a minute on that. The first numbers indicate that perhaps the food inflation is likely to have been higher than what the street was expecting. Our poll for the food inflation was about 6.1%, but we had a wide difference over there, with some people expecting 5.5%. On the calculation that onion inflation actually picked up towards the end of September, but there were quite a few people who were expecting 6%, a 6.5% rise in food prices because of onion prices and cereal prices. We will come to the food inflation in just a bit. I think we have those numbers now. The food inflation has risen by, oh God, I really wish the numbers come in a little faster. Okay, 6.6%. So the majority was right, 6.6% jump in food inflation. So looks like the onion inflation and the cereal inflation has caught up after all. Let's see if we can get more individual numbers. Okay, cereals inflation is 10.65, very much like the inflation was in the month of September. Eggs has reduced a bit, or no, not much. 9.3% is the egg inflation. Meat and fish, 3.27, but that was anyway low. Milk products inflation is 6.4. That's receding, as you can see. It was, I think, 6.8 in the previous month, and quite a fall from the 8% that it was raining in the first 6 months of calendar 2023. So as we approach the calving season, the winter season, we are seeing and of course a high base. Milk inflation is falling a bit. Oils, again, minus 13%. That's always been the case because edible oils became very expensive in 2022 post the Ukraine war. Fruits and vegetables. Okay, fruit is expensive at 9.3, but vegetables is only 2.7% higher. We have to get to the details because this is only the single-digit disaggregation. We have to wait for the triple-digit disaggregated number to know whether onions contributed a goodish bit. Pulses has become a serial contributor, huge contributor. 18.8% is the rise in pulses, and that was expected to be a very big offender. Sugar is 5.5%, spices 22%, but its weight in the overall percentage is less. Overall CPI calculation is less. We can come to now food and clothing. Food and beverages is 6.24. Clothing is 4.3. All those have not contributed much. Housing is 3.8. That's still very much controlled. And then you have the miscellaneous expenses, which is largely services. That's up 4.4. But within that, the highest contribution comes from personal care and effects, which is 7.8. My guess is it could be gold prices, which were high in October, but we still don't have that breakup. Otherwise, education 5%, recreation 3%. The others are very much under control. Health, health is big, 5.9%, and household goods and services 3.9%. So that's the entire lot. Food contributing 6.6, I think largely pushed up by pulses and cereals, but we will have to wait for more details. With that initial set of numbers, let me invite my guests. Shubhda Rao, the chief economist and founder of Quant Eco, an independent economics research institution. Nikhil Gupta, the economist from Motilal Oswal Financial Services. Aditi Nair, chief economist, ICRA. and Jayesh Mehta, the country head, Bank of America, to tell us how the bond markets will react. Jayesh, coming to you in just a bit. First, the Economist. Shubhda, what do you make of the numbers?
Hi, thanks, Latha. Good to be back on your show in this Diwali season. 4.75 is where Quantico was. So clearly it has come a tad higher than what we were anticipating. Our own expectation was that a large part of onion price escalation would be felt more in November and not as much in October. We were also looking at cereals and pulses continuing to exert pressure on the headline number. So the good part and the bad part, tomatoes have receded, but that have been replaced by onions. The concerning part is cereals and pulses, which continue to inch up higher. So food inflation continues to provide the worrying aspect in the overall headline inflation. So that is going to be on watch even going forward in the next couple of months as well.
Okay. Thanks for that initial matter, Shubhda. And very much like you, there were other economists who also told us that they were not sure how much weightage to give onions, and we are still trying to find out. But I think we've now got from Cogensis, this is their calculation, that the core inflation is 4.2. The average I got was 4.4 when I polled about a dozen economists. Anyway, less than 4.5 in September, but it looks like core inflation has fallen more than expected, which is, of course, very good. Aditi, what have you made of the first numbers? Aditi, I think you're on mute. Aditi, we can't hear you. Okay, I'll just get back to Aditi. Nikhil, can you take over and tell us what did you make? Core sector lower than expected, food higher than expected?
Hi, Latha. Yes, so core headline inflation, Latha, is broadly in line with our expectations. We were expecting 4.9% headline and 4.4% core inflation with 6.5% food inflation. So broadly, the numbers are in line with expectations. But we also believe that October is probably going to be the kind of trough for this headline inflation. So we are happy that it is broadly in line, but we do see inflation picking up from next month onwards.
Okay. Yes, that was the impression I got, and I was going to ask the other economists as well. What are they expecting of October? I think we have got Aditi back. Aditi, I think you were on mute, but if you can tell us whether the numbers are worse than you thought, and more importantly, if this is the trough, as Nikhil just said, at 4.9, then where are we headed in November and December?
Thanks, Latha. So the number was in line with what we were expecting, both for headline and for food. So we didn't find any surprises. Our headline was penciled in at 4.9% for this month. And my view is that we're actually going to remain flattish in the month of November. And then we're going to be in for quite a volatile ride going ahead over the next 6 odd months. So there's not going to be any very clear pattern which is going to emerge out of the CPI inflation numbers from 1 month to the next, because there are loads of base effects. That's always the case, but I think that's particularly so in the next few months that lie ahead. Complicated with the food inflation dynamics that we are seeing right now. So for this quarter and for the next quarter, I think the good news is that CPI inflation averages are going to be lower than what the MPC had last indicated in October. So for the year as a whole, as of now, we're looking at a number of about 5.2%, so a little bit lower than what the MPC had said. But we don't think that the monthly prints are going to provide any kind of conviction in the next few months to enable an early rate cut.
Okay, but I don't know. I mean, maybe I would be very happy if it came at 5.2. But the month-on-month rise in food prices is crazy. Cereals and products 0.8% higher. And this is the time when the harvest comes into the market, isn't it? That was the time in October when we thought that the rains were not all that bad. So even, psychologically, the traders should not be pushing up prices. This is a little worrisome. And guess what? Pulses are up 2.5% month on month. I mean, it's crazy if it rises at this level. And vegetables are up 3.5%. So as I had some elementary evidence, even tomato inflation was back a bit. And onion inflation seems to be really bad. 3.4% month-on-month increase in vegetables, pulses and cereals also contributing hugely to the inflation. I'm coming back to you, economists, in just a minute. But Jayesh Mehta has been patiently waiting by. Jayesh Mehta, does the market care? It looks like 4.9, less than 5. We are only going to look at the US Treasury yields. Is that how the bond markets will take
Absolutely.
it?
No, absolutely. That's what you said, right? We are in a range bound. We are kind of capped at 440 as of right now. And then, on the floor side, because of US, we are not going below 6 quarter and 640, 7 quarter and 740. But then I think from a bond market perspective, that would be a little bit of relief, especially the core coming down. Next month, people are expecting inflation would be higher, but that would be priced in. As long as core remains maintained, bond market will not look at the local market. It's only the global market. And that's where, 15 basis point daily move up and down, it's not too good. But we have been very resilient in that.
Okay, now we have to come to the month after. Shubhda, have you all done the math? I know you may have to go back and redo the math after looking at the October numbers. But what's your expectation for November as of now? And therefore, what may be the quarterly? November is, I don't think the Reserve Bank even has the November number when it goes into the monetary policy. Would it be worried with this inflation number?
I would think so that, this current print of 4.87 or below 5% is a short-term comfort. We do believe that November and December are both going to be back above 5%. Our own estimation is anywhere close to 5.4 or 5.5, depends on how quickly or onion prices escalate or de-escalate. But at this point in time, we are looking at November and December, both well above 5%, somewhere around 5.4 or 5.6. So overall for the quarter, it would still perhaps be closely hugging at 5.6, 5.5, which is where RBI estimate is. But we do not see any downside surprise clearly coming over the months of November and December. And as you rightly pointed out, Latha, I mean, even despite the harvest coming, items like pulses and all are still month over month escalating. That's not a very great news. The rains have actually begun to manifest in the actual harvest and the expectations around the pricing of these very items. So my sense is Q3 is going to be somewhere around 5.5, 5.6, pretty much in line with RBI. Q4 could see some retracement, some base effect, some of, the non-food inflation also relatively well behaved so far. So I would think that Q4 could be in the range of 4.5 to 5%, but Q3 is definitely well around 5.5%. That's what our estimate is.
Shubhda, that's not what I got from some of the economists. I mean, the majority are with what you're saying, like Aditi just said. But I had clearly a few economists saying that they are worried that the third quarter inflation is going to be higher than the 5.6 that the Reserve Bank has forecast. The expectation, there was one economist with even a 6 to 6.5% expectation for November, and he would perhaps be justified in doing that because this October number has come in higher than our poll at least. Nikhil, which camp are you? What are you expecting in November and the third quarter in general?
So Latha, we are expecting close to 5.5% in November, which could pick up to 5.7, 5.8% in December. So for the full quarter, that is December quarter, we are expecting it close to 5.5%, and RBI is at 5.7%. So slightly lower than what the RBI forecast currently is. For Q4,
but will you change your mind? Will you change your mind because of the way pulses have come, or you have factored it in? I thought pulses and cereals are looking steaming.
We have factored that in. There is slightly, so you're right that onion prices are going up. And even in November, we looked at the data for the first 10, 12 days. There is a growth of some 40% in onion prices. Even potato prices are going up. So we are seeing that kind of pressure. But then we also need to look at other vegetables. For example, brinjal, which is down almost 20%. We need to look at green chilies, ginger, which are down 10 to 15% on month to month. So overall, we still see inflation closer to 5.5% for November, based on the vegetable prices that we have for the first 10 to 12 days of the month.
Okay, so I think the majority is quite clearly saying that inflation is going to undershoot. You'll all have agreed with Aditi. Aditi, just a final point on this. Do you therefore, expect that core inflation is only, I mean, this is the best we can get, or can we get even better or even lower core inflation prices, core inflation levels?
So Latha, just to recap, see, the number that we got today is in line with our expectation, and the stickiness, the problems that we're seeing in cereals and pulses is already baked into that. While onion prices are a problem, as Nikhil just said, a lot of other vegetable prices are now going to show their normal seasonal downtrend, and that is going to offset some of the pain that we are going to get from onions and maybe tomatoes and potatoes. So for December, we are also looking at a number of 5.5%. And then we're expecting some cooling to come in Q4. So for Q4, the average that we have is 5% or less.
Got it.
On the core inflation side, I think we can get some better prints. But overall, our concern is that headline inflation is going to remain volatile in a band of this, let's say 490 as a base, going up to 550. Not only in this quarter, but also remaining in a pretty wide band for at least the next quarter and a half. And therefore, we're just not going to get very clear signals coming out of the headline CPI inflation number to provide comfort one way or another to the MPC and the RBI.
Okay. Jayesh, nothing in these numbers are slightly higher than the poll, but as our economists are saying, it's in line with the RBI's quarterly forecast. Perhaps it will even surprise a little bit lower, according to Aditi. Do you therefore think that this OMO sales was just a red flag that they waved to prevent the market from getting too exuberant? Or do you expect an OMO sale sometime?
No, we do expect some OMO sales sometime. It's purely because of the liquidity. I think, you see, whenever it's basically the systemic...
1 minute, Jayesh, 1 minute.
Yeah.
Q1, the early part of the month, we had a couple of redemptions. So there were people in the market telling me that there could be an OMO sale because the redemptions will, push the market into surplus. But that didn't happen. The RBI was supplying, we were in liquidity deficit. But November end as well, there are some redemptions. Are you expecting OMO sales as early as that?
Not really, see, because you also have FX intervention, right? So from that perspective, that is kind of taken care of. But of course, if government suddenly starts spending a lot, that is where they will keep a buffer for that OMO sale. But I don't think that in this kind of situation, they would kind of manage and deferring the OMO sales.
They would prefer deferring the OMO sales. I mean, around what time are you expecting it?
So it's not about timing. Timing could be, if there is government spending more happening and there is a system becomes quite surplus, or if the intervention on FX side stops, that is again could be the situation. It's only when they feel the system is surplus enough, that's when they will do an OMO sales.
Okay. Do you think the OMO sales comes when the call rate moves below 6.75? I think it has been at that level from what, September?
Absolutely.
Or even earlier?
Absolutely.
Okay.
So that's where the situation.
Okay. Well, now for the most important set of questions which will interest both economists, business and bond markets. What's the next action from the Reserve Bank? Shubhda, when at all are you pricing in a cut or even a change in stance?
I would think RBI will continue to play its hawkish card without taking any rate action, at least for the near term. We do not expect rates to be tinkered or looked at all until the end of Q1 FY25, which is June of 24. A rate cut window perhaps could open up during the second quarter of the next fiscal year. But so far, I think RBI has adequately and more than adequately signaled that all the calibration on short-term money market rates, etc., is going to be signaled through the liquidity management. And that's what it's doing. So we believe the hawkish undertones would continue for some more time.
And the cut is what, June of 24? I mean, any approximate timing at the moment?
For us?
Yes. I mean, the rate cut from RBI would be what, mid 24, second half 24?
I would think mid 24.
Okay. Nikhil, your thoughts?
So we don't see any rate action from the RBI in next policy, but we do expect them to continue with cautious stance. As far as rate cuts are concerned, we don't think there would be any rate cut until and unless there is a either global slowdown or India slowdown. The first one probably with a higher probability. As and when it plays out, we could see rate cuts. RBI doing rate cuts following the US Federal Reserve and the growth slowdown. Otherwise, we don't see any rate cuts requirement.
I take your point. You can't do that when the US 10-year yields are at 5% or edging towards it. Aditi, what do you, in terms of tone and action?
So this policy continued hawkish tone and no change in the rates or the stance. Earliest rate cut that we expect would be in August of next year. And even if once the rate cut cycle starts, we expect it to be very shallow, 50 to 75 basis points at best between the August and the December policies of 2024.
Oh, 2024. That we are some distance away. There can be so many events. I take your point. Jayesh, the most important question to you. What's likely to be the 10-year range? Does it stay in the current 7.3%, give or take 5 basis points? And what about cost of capital for corporates? Does it get more expensive?
No, I don't think cost of capital definitely does not get, because there's not enough supply coming, at least as I'm talking about the bond market purely. Corporate bond also, there's not enough supply there. We have large demand coming both local and global, and from Jan to March quarter again. So I think it was, you're right. So it's 730 plus minus 10 basis point is where we would be. Unless, US really goes down to maybe 3.5 level or something like that. Maybe that's a different situation. Then the expectations start building up here. But I think otherwise we remain in that range. And of course, it crosses 5 quarter. Both sides would be a different situation.
Okay. Well, economists reacting to the Moody's change in outlook of US Treasuries, who spoke to us earlier today, said that US Treasuries, at least the 10-year yield, is likely to remain at the 4.5 to 5% mark for now because of the fear of high fiscal deficits in that country. So I guess to keep the interest rate differential and to not invite any, speculative attack on the rupee, most emerging markets will have to keep an eye on their own interest rates, which is, I think, why an added reason why the Reserve Bank will keep liquidity tight. Of course, Indonesia has even gone and raised rates. So we should expect that at least near-term yields are likely to be higher and not lower in the immediate term till, of course, the US yields recede, as our experts are pointing out. Thank you very much. With that, we wrap up this discussion on the state of the economy, on the inflation numbers that have just come in, and how the bond markets are likely to react. Shubhda, Aditi, Nikhil and Jayesh, thank you very much for joining us with your special comments. Just to summarize, for those of you who joined in late, the inflation number at the headline level has come in a little higher than the CNBC-TV18 poll. Our poll said 4.8. It's come in at 4.87, more like 4.9%. The food inflation is definitely higher than what we expected. It's coming at over 6.6%. Okay, 6.6%. Our expectation, or poll threw up 6.1%. The most difficult numbers over there are pulses, which are rising at 18% year on year, and cereals, which are up nearly 11% year on year. Those are the ones that will be tricky. But core inflation at 4.2 would be a huge salve for a worried Reserve Bank. With that, we wind up this special edition. Keep it with CNBC TV18. More news and updates lined up for you.